Happy Friday, everybody. It's Rob Campbell, the mortgage broker. I thought I would take this opportunity to talk to you today about payment shock and what exactly payment shock might mean to you if you are in a mortgage currently with a fixed rate and you're up for maturity this year or even next year, but predominantly this year. So what we're going to do is we're going to do a little drawing on the desk here down below. So I'm going to switch the angle and we will now talk about payment shock. So what you have to understand is, with where current rates are going, and they're only starting to go up now as we've seen over the last 6 to 12 months, let's pretend that you took a 5-year mortgage about 5 years ago, maybe 4.5 or almost 5 years ago. So your mortgage is going to be, let's say you took a $500,000 mortgage, okay, and it was over a 25-year AM, okay? And that payment would be $2,262 per month based on the loan amount over a 25-year AM at about a 2.59% rate. Okay, that's a standard rate 5 years ago, coming upon 5 years ago if you're approaching maturity this year. Now, something you need to remember is that because we're amortized over 25 years and the original loan was $500,000, at maturity, you are going to be around $424,000 remaining. Okay, that's without any prepayments. No prepayments, no top-ups, no bulk payments towards your prepayment privileges. Now, why this is so important is because it costs you $2,262 per month, but now you're coming up for renewal. And we see these questions all the time within our brokerage, and other brokers and lenders will see it out there as well. Upon maturity, we get the question about, well, why is my payment higher if I have less time remaining on my mortgage? Well, that's because, generally speaking, you're going to be qualifying at this balance of 424. Remember, we took it from up here at maturity. And today's rates are in and around 3.89%. But remember, and that's a 5-year fix, by the way, but remember, you're going to have 20 years remaining, okay? 20 years remaining because you started with 25 and now you're down to 20 years remaining. So what does that payment look like per month? Well, $424,000 balance over a 20-year remaining amortization at 3.89%, which is what we're currently sitting at. You know, it's not exactly apples to apples, but you're going to get the point. That payment is going to be $2,538 per month. Okay, and that's principal and interest. I'm sorry. So $2,538 per month. So as you can see, we went from this to this. That is an increase of around $275 per month. It's gone up. And why has it gone up? Because rates have gone up and your amortization has gone down. So that's just using 3.89%. Now, currently, there's upward force on fixed rates still. So if you're not maturing for another 6 months or so, you could be at over 4%. Now, you know, if we go back to this original rate of 2.59, let's say that you bought your first home and you got your mortgage last year and your rate was at, if you were at 1.89% when you originated that mortgage last year, and if these rates stay the way they are in the next 3, 4, 5 years, you could see a a payment shock of around $410. I mean, all the way up to like $500 a month if rates go up to 4.25 or higher. So this is what this video is about. Payment shock. Cost of gas is going up. Cost of food is continually going up. If you have a family, you know as well as I do that it costs a lot of money to feed your family. All expenses are starting to go up. And remember, with the Bank of Canada, with the overnight lending rate, that's predominantly affecting variable rate mortgages. It also affects home equity lines of credit, which could see a little bit of interest go up for your payments. But the real elephant in the room is payment shock when you're coming out of a lower interest rate into a higher interest rate with a lower amortization. So where we see this play into personal finances and debt repayment is that typically the average Canadian or clients that I've experienced or applicants that we've experienced at our brokerage are going to want to re-up the amortization back up to 25 or 30 years. Of course, that's going to help your cash flow per month, but it's not going to help you become mortgage free sooner. So message today is really be aware of payment shock moving forward, and consider that when you are thinking about the renewal process, whether that's this year or next year or the next. How do you get around payment shock? Well, you can, if you can afford it, seriously consider topping up your mortgage payments with the allowable prepayments that your lender will let you take advantage of. That could be 15% top-up payments, 20%. Think about maybe going from monthly to accelerated bi-weekly. There's a bunch of different options there when it comes to your mortgage, but payment shock is going to be the word you're going to hear more and more of, and really start to feel that pain if you're not prepared for it. I'm Rob Campbell. I'm a mortgage broker. Please reach out if you have any questions. Have a great day. Bye-bye.